Something important has started and most people are not paying close enough attention to it. It is not one headline. It is not one bad year in the market. It is not only about China or oil or the dollar or inflation. Those are symptoms. The deeper reality is that the system that shaped money, trade, and investing for most of our lives is changing. When a system changes, most people first deny it, then they argue about it. Then they panic after prices have already moved. That is how human nature works. It is also why the biggest opportunities and the biggest losses usually appear during the same periods. Right now, the dollar is having one of its weakest stretches in decades. Oil prices are rising, which increases the risk of inflation pressure and slower growth. And for the first time in modern history, the United States is beginning to face a serious challenge in global trade and financial influence from China and from a wider group of countries that did not have this kind of power a generation ago. This does not mean the United States is finished. That would be too simple, and simple answers are usually wrong. It means the world is moving from a one-power system toward a more multipolar system. That is a very big distinction. When the world was dominated by one reserve currency, one military superpower, one deep capital market, and one primary trade architecture, investing was easier. You could put most of your money in American assets, and for a long time, that was the winning bet. But when power begins to spread, when capital begins to diversify, when countries start asking whether they should hold fewer dollars and more gold, fewer treasury securities and more local currency settlement systems, then you need to stop thinking in slogans and start thinking in systems. That is what I want to walk through with you. I want to show you what is happening to the world order. I want to show you why the dollar is losing ground faster than most people realize. I want to show you what that could mean for your money over the next decade. And then I want to show you the practical way I would think about positioning, not from fear, not from politics, but from principles. Because the people who understand a changing system do not only protect themselves, they can also benefit from the change. Before we talk about what major institutions are now forecasting, we have to understand why the forecasts are changing at all. The reason is the changing world order. I know that phrase sounds dramatic. It is often used carelessly, but the concept is real. Over the last several hundred years, when the global financial order changed, fortunes changed with it. When the Dutch had the reserve currency and then lost it, wealth shifted. When the British Empire dominated trade and finance, and then the United States replaced it. Wealth shifted when the dollar became the center of global finance after World War II. Wealth shifted again. Those shifts did not happen in one day. They happened slowly. Then suddenly they started with small changes that most people ignored. Trade routes changed, debt levels changed, military strength changed, productivity changed, education and technology changed, reserve holdings changed. Then, after enough small changes accumulated, people looked around and said the world had changed. That is the way cycles work. After World War II, the United States became the dominant economic power. The dollar became the world reserve currency. Other countries needed dollars to settle international debts, buy oil, and conduct trade. Central banks held dollars because dollars were liquid, accepted, trusted, and backed by the largest economy and the deepest financial markets in the world. That gave the United States what economists sometimes call an exorbitant privilege. In plain language, it meant America could borrow cheaply. It could run larger deficits than other countries. It could print more money than other countries could print without immediately suffering the same consequences. It could finance its government, its military, its consumption, and its investment, partly because the rest of the world wanted and needed dollars. That was an enormous advantage. But advantages create habits, and habits, when taken too far, create weaknesses. When a country can borrow cheaply for a long time, it tends to borrow more. When it can run deficits without immediate punishment, it tends to run bigger deficits. When the world continues to demand its currency, it can become less disciplined than it otherwise would be. That is not a political statement, it is a system statement. It has happened again and again in history. Now fast forward to where we are today. The balance of global economic power has changed. Countries such as China, India, Brazil, Russia, South Africa, the UAE, and others have become much more important in global output, trade, energy, and commodities. Groups such as BRICS now represent a very large share of the world economy by purchasing power, while the Western countries that built the post-war system represent a smaller share than they once did. This does not mean the West is weak in every way. It does not mean the United States has lost all its advantages. It means the relative balance is changing. That is the key in investing. And in geopolitics, relative change often matters more than absolute change. A country can still be strong while becoming less dominant. A currency can still be the reserve currency while losing share. A market can still be the deepest market in the world while no longer offering the same future returns it offered in the past. That is the kind of situation we are in now. To understand it, look at the dollar. In 2016, the US dollar made up roughly 65% of global foreign exchange reserves. That is the share of reserves that central banks chose to hold in dollars by 2024 that had fallen to around 59%. By 2025, it was closer to 57%. That is not a collapse, but it is a meaningful decline. And the direction matters. For a long time, it was rational for foreign governments and central banks to hold dollars. Dollars were accepted everywhere. They were needed for trade. They were backed by a powerful legal system, deep treasury markets, and the strongest military in the world. Then the United States froze Russia's foreign reserves after the invasion of Ukraine. Whether you agree or disagree with that decision is not the investment point. The investment point is that every country that is not fully aligned with the United States saw what happened and drew a conclusion. They thought, if that can happen to Russia, it can happen to us. That one realization changed incentives. When incentives change, behavior changes. Countries started diversifying more aggressively. They bought more gold. They began settling more trade in local currencies. They built or tested payment systems that could bypass dollar infrastructure. They looked for ways to reduce the risk of being dependent on a system controlled by another power. That is what many people call de-dollarization. It does not mean the dollar disappears. That is not how reserve currency transitions usually work. It means the dollar is used less at the margin. It means other countries slowly build alternatives. It means the system becomes less centered on one currency, and you do not have to replace the dollar completely in order to weaken it. You only need to give enough countries enough reason to use it less. China is one of the most important examples. In 2010, China held a very large portion of its reserves in U.S. treasuries. It was effectively lending huge amounts of savings to the United States government. By the middle of this decade, that share had been cut substantially. At the same time, China developed its own cross-border interbank payment system, commonly called CPIS, which helps facilitate transactions in yuan. It is not replacing the dollar overnight. It is not ending SWIFT tomorrow. But it is taking small pieces of market share and building parallel capacity. That is how transitions begin. Then there are bilateral trade settlements. Instead of two countries trading with each other through the dollar, they settle directly in their own currencies. China, India, Russia, and others have been moving in that direction. In different ways, it is not always smooth and it is not always efficient, but it reduces dependence on the dollar. Then there are gold purchases. Gold is not someone else's liability. It cannot be printed by a central bank. It is not tied to the credit of one government. It is not subject to the same kind of freezing risk as bank deposits or treasury holdings. That is why central banks have been buying it. Gold does not produce cash flow. I always care about productive assets. But in a changing reserve system, gold has a role as a neutral reserve asset. Then there are alternative payment systems such as BRICS Pay, designed to allow member countries to transact in their own currencies without routing everything through the dollar or through Western-controlled messaging networks. Then there are experiments such as mBridge, a blockchain-based cross-border settlement framework tested by several central banks. These systems are early. They are not yet replacing the existing infrastructure, but they show the direction of travel. There are also proposals for new settlement units backed partly by gold and partly by baskets of BRICS currencies. Again, most of these ideas are not fully mature. Some may fail, some may take many years. But the key point is that the desire to build alternatives is no longer theoretical. It is happening. The mistake most people make is thinking in extremes. They ask, will the dollar collapse or will nothing happen? That is the wrong question. The better question is, what happens if the dollar slowly loses dominance while remaining important? What happens if the United States remains powerful but is no longer the only center of global capital? What happens if the next decade does not look like the last 2 decades? That is the investment question. When the system gets more uncertain, many people try to time everything perfectly. They try to jump from one asset to another. They try to predict exact turning points. That is usually a mistake. The better principle is diversification. Diversification is not exciting. It does not make good headlines. But it is one of the most important ways to survive and benefit when the future is uncertain. Some investors have started adding small allocations to assets outside the traditional system, including digital assets. Whether that makes sense depends on the person, the size, the risk tolerance, and the time horizon. I would never treat any highly volatile asset as a substitute for a well-built portfolio. But the underlying instinct is understandable. When people lose trust in a single system, they look for alternatives. That is not new. The important principle is this. Do not confuse diversification with speculation. Diversification reduces dependence on one outcome. Speculation depends on one outcome happening quickly. Those are very different behaviors. Now let us come back to the larger shift. There is another force that may matter even more than China alone, and that is global diversification toward faster, growing parts of the world. China matters. It has grown into a great power. Some forecasts suggest it could overtake the United States in economic size over the next decade or so, depending on how one measures the economy and depending on what happens with productivity, demographics, debt, and capital controls. But the deeper story is not just China. India is becoming one of the most important forces in the global economy. Its population is enormous. It is younger than China's. It is increasingly digital. It has a rising middle class, a large technology sector, and long-term growth potential that many investors still underestimate. If India becomes a $10 trillion economy over the next decade or so, that would change capital flows, consumption patterns, manufacturing, services, and global market weights. Then there are other emerging markets that will also matter. They have more room to grow because they are starting from a lower base. Their financial markets are less mature, which creates more risk, but also more potential return if development continues. By 2050, emerging markets are expected by some forecasts to make up a much larger share of global stock market capitalization than they do today. India alone could meaningfully increase its share. That is why the average American investor needs to ask a difficult question. Am I diversified across the world, or am I just diversified across American companies? The average American investor often has most of their money in U.S. markets, especially the S&P 500 for the last 50 years. That made a lot of sense. The United States had the deepest markets, the best companies, the strongest innovation, the most trusted legal system, and the dollar advantage. For many people, that strategy worked extremely well. But good strategies can become crowded. And when a strategy becomes crowded, future returns usually come down over the last year. Major institutions have updated their long-term return forecasts. The numbers vary by institution, but the general direction is similar. U.S. stock returns are expected to be lower over the next decade than many investors have become used to. International stocks and emerging markets are often projected to offer higher expected returns, partly because they are cheaper and partly because they have more room to grow. That does not mean those forecasts will be right. Forecasts are not destiny, but when different institutions with different models reach similar conclusions, a thoughtful investor should pay attention. There is also concentration risk inside the U.S. market. The top companies now make up a very large share of the S&P 500. That does not mean they are bad companies. Many of them are extraordinary companies. But when a small number of companies drive a large share of the index becomes less diversified than many people believe. You may think you own 500 companies, but a large amount of your return can depend on a small group of mega-cap stocks that can work very well on the way up. It can also create vulnerability if leadership changes. Then there is the dollar effect. If the dollar weakens over time, foreign stocks can become more valuable to a U.S.-based investor simply because their returns are translated back into weaker dollars. The business may earn the same amount in local currency, but the U.S. investor may receive a better dollar return because of the currency movement. That is not guaranteed. Currency moves can go both ways, but it is part of the system. Think about the debts and deficits. When a country has a large debt burden and continues to print or borrow to finance spending, the long-term pressure on the currency is real. It may not appear all at once. It may be hidden by global demand for safe assets. It may be delayed by the lack of alternatives, but the pressure exists. So what should a person do? The wrong answer is to panic. The wrong answer is to sell everything in the United States. The wrong answer is to believe that the dollar will vanish tomorrow. The right answer is to understand the probabilities and adjust gradually. The United States still has enormous advantages. It has the largest and deepest capital markets in the world. It has strong institutions compared with most alternatives. It has unmatched military reach. It has leading companies in artificial intelligence, semiconductors, biotechnology, software, finance, and many other high-value sectors in a crisis. Money still often flows into the United States because investors trust its liquidity. The dollar is still used in the vast majority of foreign exchange transactions. It still represents a very large share of global payments. Even many alternative systems still connect back to dollar infrastructure in some way. China has capital controls. Europe has political fragmentation and debt challenges. Gold cannot settle modern commerce in real time. Bitcoin and other digital assets are too volatile to function as stable reserve assets in the short term. So the realistic picture is not dollar collapse. It is dollar dilution. The United States is not necessarily becoming irrelevant. It is becoming one superpower in a world with more than one meaningful pole of power. That transition can take decades, but the early money starts adjusting before the transition is obvious to everyone. That is why this matters. Now, if I were thinking through this as a portfolio problem, I would begin with the principle: do not go all in on any one country, even the best country. A country can be strong and still deliver lower forward returns. A market can have great companies and still be expensive. A currency can remain dominant and still lose purchasing power. So I would not abandon the United States, but I would not depend entirely on it either. The first adjustment is international diversification. This does not have to be complicated. A simple international index fund can give exposure to developed markets and emerging markets outside the United States. It spreads risk across currencies, economies, and political systems. Will every international market outperform? Some will disappoint. Some will have governance problems. Some will be volatile. That is why diversification matters. You are not betting everything on one country. You are accepting that the world is bigger than one market. The second adjustment is emerging markets. Emerging markets are riskier. They have political risk, currency risk, liquidity risk, and governance risk. But they also have more room to grow. If global capital begins to rotate toward countries with younger populations, rising productivity, and lower valuations, emerging markets can benefit. This does not mean you should chase every emerging market story. That is how people lose money. It means having measured exposure to the part of the world where much of the future growth may come from. The third adjustment is precious metals. I do not think of gold as a productive asset. It does not compound through earnings. It does not innovate. It does not build factories or create software, but in certain environments, gold plays a useful role. When central banks are buying gold because they want an asset outside the dollar system, investors should at least understand the signal. Gold can serve as a hedge against currency debasement, sanctions risk, and monetary disorder. I would not build a whole financial life around gold. But a small allocation can make sense as part of a diversified system, especially when debt cycle dynamics are becoming more important. The fourth adjustment is commodities. Commodities are the physical inputs the world needs to function. Oil, metals, copper, food, energy infrastructure, and other basic materials matter more when the world is moving through supply shocks, geopolitical conflict, and emerging market growth. When billions of people demand more electricity, more housing, more transportation, more technology, and more food. The inputs become important. Commodities are volatile, they are cyclical. They can produce long periods of disappointment, but in a world where the dollar slowly loses some influence, where inflation risk remains higher than people expect, and where emerging markets grow, commodities can provide useful protection. The fifth adjustment is to keep a meaningful U.S. core. This is very important. Do not confuse rebalancing with rejection. The United States still has the deepest capital markets, the strongest technology ecosystem, and many of the best businesses in the world, even if future returns are lower than the past. Abandoning the U.S. entirely would be a mistake. The point is not to run away from America. The point is to stop assuming that the exact strategy that worked for the last 20 years will work equally well for the next 20. That is a different mindset. No serious investor should make decisions based on panic. Panic compresses time horizons. It makes people overreact. It turns probabilities into emotions. Instead, think in scenarios: if the United States remains dominant and the dollar remains strong, a U.S. core continues to work. If the United States remains strong but returns moderate, international diversification helps. If the dollar weakens slowly, foreign assets, gold, and commodities can help. If emerging markets gain share in global growth, having some exposure can matter. If inflation stays higher than expected, real assets and productive companies with pricing power become more important. That is how a principles-based investor thinks. Not what headline will be true tomorrow, but what portfolio can survive multiple futures. Most people do not think that way. They want certainty. They want someone to say the dollar will collapse or the dollar will be fine. They want to know whether China will overtake America or fail. They want a clean answer because clean answers reduce anxiety. But markets do not reward emotional comfort. They reward those who deal with reality, and the reality is mixed. The dollar is weakening in relative terms, but it is still the core currency of the system. China is rising, but it has serious internal problems. India has great potential, but it must still execute through many challenges. Emerging markets may outperform, but they will be volatile. Gold may help, but it will not compound like a great business. Commodities may protect against inflation, but they will move in cycles. U.S. stocks may produce lower future returns, but the United States still owns many of the strongest companies on earth. All of those things can be true at the same time. That is why balance matters. In my experience, the biggest mistakes in markets usually come from extrapolation. People take what has worked recently and assume it will work forever. They take the last decade and project it into the next decade. They confuse a good past return with a safe future return. That is dangerous. The last 2 decades rewarded heavy U.S. exposure, especially to large technology companies that may continue in some form. But the price you pay matters, valuation matters, concentration matters, currency matters, global power matters if the world is becoming bigger. And if growth is becoming more distributed, then your portfolio should reflect that possibility. You do not need to make one dramatic move. In fact, dramatic moves are usually a sign of poor preparation. Small adjustments made early can be much more powerful than large adjustments made after everyone else sees the problem. That is the opportunity. The world is not getting smaller, it is getting bigger. More people are entering the global middle class. More countries are building payment systems, industrial capacity, and financial markets. More governments are trying to reduce dependence on the dollar. More investors are starting to look outside the United States for value. If you understand this, you can position gradually. If you ignore it, you may wake up years from now with a portfolio that was built for a world that no longer exists. I am not saying that the United States is doomed. I am saying that assuming permanent dominance is not a plan. I am not saying the dollar disappears. I am saying that even a slow reduction in its dominance can change returns. I am not saying to chase China or India or gold or commodities blindly. I am saying to build a system that does not depend on one country, one currency, one market, and one version of the future. That is the principle. The best investors are not the ones who predict everything perfectly. No one does that. The best investors are the ones who understand the forces at work, position themselves with humility, and let time do the heavy lifting. That is how I would approach this period. Stay flexible, stay diversified, stay aware of the debt cycle, the currency cycle, the geopolitical cycle, and the market cycle. Do not panic out of the United States. Do not blindly assume the United States will repeat the same returns forever. Do not treat the dollar as if it has no risks. Do not treat alternatives as if they have no risks. Build a portfolio that can handle a world where the United States still does well, and a world where other regions begin to catch up. That is not fear, that is prudence. And if this transition continues, the people who benefit most will not be the ones who shouted the loudest about collapse. They will be the ones who quietly recognized the shift, adjusted early, and allowed compounding to work across a broader set of opportunities. That is why I think this could become one of the most important investment opportunities of the next decade. Not because the dollar ends, not because America disappears, but because the world order is broadening, and most portfolios are still built as if it is not. When a system changes, you do not need to be dramatic. You need to be early, rational, and balanced. That is how you protect yourself. That is how you participate. And that is how you avoid being surprised by a change that was visible long before most people chose to see it.